studying your last two. I swim med when they turned in. The staring down to mute. And can learn the pole that sunk he died.
In this final section of the chapter, we expand our view beyond income taxes and look at other payroll costs that can significantly affect owner-manager compensation planning. One of the most common mistakes business owners make is focusing only on the salary they intend to pay, without considering the additional employer costs that may arise as a result of that salary. When a corporation pays salary to an owner-manager or any employee, the salary itself is only one part of the total cost. The employer may also be responsible for several payroll-related obligations, and these additional costs can have a meaningful impact on the corporation's overall cash flow and tax planning decisions. The first additional cost is the employer's contribution to the Canada Pension Plan, or CPP. When salary is paid, the corporation may be required to contribute the employer's share of CPP in addition to the employee's contribution. This increases the corporation's total payroll cost beyond the salary amount alone. Another potential cost is employment insurance premiums. Depending on the employee's circumstances and whether the employment is insurable, the corporation may also be responsible for the employer's portion of EI premiums. As we discussed earlier in this chapter, owner-managers and family members may be subject to different EI rules, making this an important factor in compensation planning. In some situations, employers may also need to consider the Workplace Safety and Insurance Board, commonly known as WSIB. Depending on the nature of the business, industry classification, and the applicable provincial rules, WSIB premiums may represent another payroll cost that should be considered when determining total compensation. Another important employer cost is employer health tax, or EHT. In jurisdictions where this tax applies, employers may be required to pay an additional payroll-based tax once certain thresholds are exceeded. Although EHT is not paid directly by the employee, it still represents an additional cost to the corporation and should be included when evaluating compensation decisions. Notice how all of these costs accumulate. The corporation pays the salary, but it may also pay CPP contributions, EI premiums where applicable, WSIB premiums, and employer health tax. Each individual amount may appear relatively small, but together they increase the corporation's true cost of employing the owner-manager. This is why professional accountants rarely analyze salary in isolation. Instead, they calculate the total employer cost of compensation. By looking at every payroll obligation together, they can compare different compensation strategies and determine which approach best balances tax efficiency, cash flow, payroll costs, and the owner's financial objectives. A helpful way to think about this is to separate the employee's salary from the employer's total payroll cost. While the employee may focus on the amount they receive, the corporation must budget for every additional payroll obligation that accompanies that salary. Understanding the full picture leads to better planning and fewer surprises. The key takeaway from this slide is simple. Salary is only the starting point. The true cost of compensating an owner-manager often includes CPP, EI where applicable, WSIB premiums, employer health tax, and other payroll-related obligations. Effective owner-manager tax planning considers all of these costs together so that compensation decisions are based on the corporation's total financial impact rather than salary alone. When developing an owner-manager compensation strategy, experienced tax professionals rarely focus on salary alone. Instead, they evaluate the corporation's total cost of providing that compensation. This broader perspective often leads to better business decisions because it considers every payroll obligation that accompanies a salary payment. Let's begin with the most obvious component, the salary itself. This is the amount the owner-manager receives as employment income. While salary is the starting point, it represents only one layer of the corporation's overall payroll cost. The next layer is the employer's Canada Pension Plan contribution. When salary is paid, the corporation may be required to contribute the employer's share of CPP. This contribution is an additional cost that must be budgeted alongside the employee's compensation. Depending on the circumstances, employment insurance premiums may also apply. Although many owner-managers are exempt from EI because of their ownership or control of the corporation, there are situations where EI premiums are required. Whenever EI applies, the employer's contribution becomes another payroll expense that increases the corporation's total cost. For some businesses, workplace safety and insurance board premiums also need to be considered. WSIB obligations depend on factors such as the province, industry classification, and the nature of the work being performed. Where applicable, these premiums become another part of the total compensation package from the employer's perspective. Another potential payroll-related cost is employer health tax. In jurisdictions where EHT applies, employers may be required to pay an additional tax based on their payroll once certain thresholds are exceeded. Although employees never see this deduction on their paychecks, it remains a real cost to the corporation and should always be included in compensation planning. When all of these amounts are combined, the corporation arrives at the total employer cost. This figure represents the true financial commitment associated with paying salary to the owner-manager. As a result, a salary increase affects far more than the employee's income. It may also increase CPP contributions, EI premiums where applicable, WSIB premiums, employer health tax, and the corporation's overall payroll burden. This is why professional compensation planning follows a structured process. First, determine an appropriate salary. Next, calculate every related payroll obligation. Then evaluate the combined tax impact on both the corporation and the owner-manager. Finally, compare different compensation alternatives to determine which approach produces the best overall result. Notice that the objective is not simply to minimize payroll costs. Sometimes paying additional payroll costs may produce valuable long-term benefits, such as pension contributions or other financial advantages. In other situations, reducing payroll costs may be more appropriate based on the corporation's cash flow and the owner's personal objectives. Good planning weighs all of these factors together rather than looking at any one cost in isolation. The key takeaway from this slide is that successful owner-manager compensation planning considers the complete financial picture. Salary is only the beginning. CPP, EI where applicable, WSIB premiums, employer health tax, and other payroll obligations all contribute to the corporation's total compensation cost. By evaluating every component together, accountants can design compensation strategies that balance tax efficiency, cash flow, compliance, and long-term financial planning. This final slide brings together everything we have discussed throughout the owner-manager compensation chapter. By this point, it should be clear that compensation planning is much more than deciding how much salary to pay. It is a comprehensive process that balances taxes, payroll costs, business cash flow, legal compliance, and long-term financial objectives. The planning process always begins with the business itself. First, the corporation earns business profits. Once those profits are available, the owner-manager must decide whether compensation should be withdrawn immediately or whether some profits should remain inside the corporation to support future growth, investments, or working capital. If compensation is required, The next decision is choosing the most appropriate method. In many cases, this may involve paying a salary. In other situations, dividends may be more appropriate. Sometimes the best solution is a combination of salary, dividends, and reimbursements, depending on the corporation's financial position and the owner's personal tax objectives. Rather than making these decisions independently, professional accountants review the entire financial picture. They consider both the corporation's tax position and the owner's personal tax situation before recommending the most effective compensation strategy. This integrated approach often produces better long-term results than focusing on a single tax return. Several important factors must always be evaluated during this planning process. Income tax is naturally one of the primary considerations, but it is far from the only one. Payroll obligations, such as Canada Pension Plan contributions, employment insurance where applicable, workplace safety and insurance board premiums, and employer health tax may all influence the final compensation decision. Cash flow requirements, retirement planning, corporate tax considerations, and the owner's long-term financial goals are equally important. Because tax rules change over time, compensation planning should not be viewed as a one-time exercise. Instead, it should be reviewed regularly. Each year, the owner-manager and their CPA should evaluate changes in corporate profits, tax legislation, payroll obligations, and personal financial objectives. This annual review helps ensure that the compensation strategy remains appropriate as circumstances evolve. Good planning also depends on proper documentation, payroll records, dividend resolutions, reimbursement records, corporate minutes, tax filings, and supporting documentation should all be maintained carefully. Strong documentation not only supports the chosen strategy, but also demonstrates compliance if the CRA ever reviews the corporation. Throughout this course, one consistent theme has emerged. Successful owner-manager tax planning requires balancing many different factors rather than optimizing a single number. A strategy that minimizes one tax may increase payroll costs or reduce long-term financial flexibility. The objective is to achieve the best overall outcome for both the corporation and the owner-manager. A professional compensation planning process therefore follows a logical sequence. The business earns profits. Compensation options are evaluated. Payroll costs are analyzed. Tax consequences are reviewed. Corporate and personal tax returns are prepared correctly, and the overall strategy is monitored on an ongoing basis. Each step builds upon the previous one to create a coordinated and compliant compensation plan. The key takeaway from this entire chapter is that owner-manager compensation is one of the most important tax planning decisions a business owner will make. Effective planning requires considering income taxes, CPP, EI where applicable, WSIB, employer health tax, cash flow, retirement planning, documentation, and CRA compliance as one integrated system. When these elements are carefully coordinated with professional advice, the result is a compensation strategy that is efficient, well documented, compliant with the law, and aligned with the owner's long-term business and financial goals.